Hi, I'm Max Keiser. This is the Keiser Report. There's another big battle going on between academics and economists versus people who really know something about the economy and the way markets work. Stacy Herbert, tell us more.
Max, well, we just came off Thanksgiving. That's my first headline, Thanksgiving tally. Lunatics and hacks win as gold up 19.3% year-to-date, S&P down 7.5%. So this is from Zero Hedge, and they're referring to Nouriel Roubini, who called those who believe in gold as lunatics and hacks. Of course, they show this chart where you see the S&P is down 7.5%, gold is up 19.3%, and yet from the propaganda pushed by the media, you would think it was the opposite.
Right. Well, Roubini is an academic who has models that he believes the economy should fit into, but it never works out the way his models suggest. And as a result, he gives horrible advice in terms of what the policy makers should do. He's one of these guys that thinks that the status quo needs to be preserved. Just keep doing more of the same, but do it bigger. That obviously, he's one of these guys who is digging a hole. His solution is to keep digging.
So let's turn to this next headline from October. I want to turn back to something about Nouriel Roubini. Economist Nouriel Roubini's firm is for sale. It has over 85 employees and is still losing money. According to the article, Max, the firm is projected to have revenues of $14 million this year, and it will post a loss of roughly $2 million, and projects 8% revenue growth into next year, followed by 40% revenue growth in 2013. So he's lost money year after year after year after year after year after year after year. Okay, we know that. But look at his projections for 40% revenue growth in 2013. It could be true, Max, if you look at the fact that technocrats around the world are taking over where democratically elected leaders used to be. So technocrats would, in fact, hire the likes of Nouriel Roubini because Nouriel Roubini provides research that validates their false theories.
Plus, we predicted that technocrats and banksters would take over these economies because the markets in the economies that are underlying them are broken. And just like when a watch or a clock breaks, you can predict what time it will tell at any given time in the future because it's broken. Same thing with these markets. They're not functioning as price discovery mechanisms. They're simply totally shattered to smithereens, and they're being used as a front to channel wealth out of the mass constituencies of the people into the pockets of the few and their useful idiot frontmen like Roubini.
And now, Max, I've talked about the technocrats taking over in Europe, and here is a prediction you predicted right here on the Keiser Report, and this is from the Financial Times, the short view by James McIntosh, and apparently, the European Commission released a paper in which they suggest one of three solutions to the debt crisis, and guess which one of them is?
Well, I know, because I read the FT. They are suggesting that Italy and other Eurozone countries put up their gold to collateralize a new round of fake bonds collateralized by now. They want to pick the pockets of these countries for their gold. I predicted that. How could I predict it? Because these markets are essentially broken and we're watching a kleptocracy. It's very obvious to predict how a cancer will predict because it's cancer. So therefore, kleptocrats, of course, will want to steal Italy's gold. That was easy to predict because they're kleptocrats.
Well, according to the article, Italy has the third biggest reserves of 2,451.8 tons, worth almost 100 billion euros. If that was used as collateral for the first loss portion of a bond, say the first 20%, it could support issuance of 500 billion euros. Coincidentally, Italy needs 498 billion euros to repay maturing debt between now and 2014.
Right, yes, the numbers work out elegantly because that's what happens when you start talking about gold and silver. They're quite precious and elegant by their own existence. But here's what I wanted to say about that. You see, the gold used to collateralize all of these euro bonds would in fact make the Eurozone and the euro somewhat attractive over the dollar because the dollar really is backed by nothing. And there's about 10,000 tons of gold in all of Europe. So the U.S. would have to retaliate by attacking the Eurozone. And in fact, they are waging a preemptive attack on the Eurozone by selling off Eurozone bonds right now. That's why you have these so-called bond vigilantes in Europe attacking these countries right now, because they fear that Europe will go to gold, and this will suck capital out of the U.S. even more than is being sucked out of the U.S. So the currency wars are on. They're happening now.
Well, a few things there. Okay. Now, in fact, I think it's the opposite in terms of the elegance of gold. I think it's the elegance of criminal rackets. And I think the design was, we see that Italy has 2,451.8 tons of gold. How can we steal their gold? And conveniently enough, exactly the precise euro amount they need is the exact euro amount of all of their gold. I think that's a way to steal, to take their gold. It was precisely designed like that.
That's right. Italy has their own gold, by the way, unlike Germany, where 60% is held in New York.
Yeah.
So if they go after Italy's gold to buttress the euro bond, this will trigger Germany's panic of their own gold, which is held in New York, and that we're going to see even more tension between Germany, the U.S., and the U.K., All the animosities from World War II, of course, are still festering.
And the other thing is, you said that of a gold-backed euro bond, I think that's a way to steal the gold of Europe. Instead, a better method for Italy would be to drop out of the euro and have a gold-backed currency, a gold-backed lira. That would be a way better strategic move on their part in the currency wars.
Of course, that's why they very quickly put in this guy Monti to run Italy, instead of having somebody who is representative of the people's interest. You remember, his nickname is Three-Card Monty. He likes to shuffle the cards around and hide the money and steal all the money because he's a charlatan.
And of course, I mean, the FT does note that this plan of backing the euro bonds with the nation's gold, it might even backfire as investors wonder if losses could exceed the 20% covered by the gold. Of course, the losses will exceed 20% because the plan is to take the gold.
Yes, of course, ultimately, the kleptocrats just want to steal the gold because they realize that in this deleveraged world of collapsing fiat currencies, he who has the most gold wins. And the central banks, of course, are aggressively buying gold for the first time in 40 years.
With that, Germany, of course, has the biggest gold reserves in Europe. As you say, they are all held mostly in New York. Germany's auction disaster stirs crisis concern. So Germany failed to get bids for 35% of the 10-year bonds offered for sale last week, propelling borrowing costs in Europe higher and the euro lower on concerns the region's debt crisis is driving away investors. Mark Grant, a managing director at Southwest Security, says this auction is nothing short of a disaster for Germany. If the strongest nation in Europe has this kind of difficulty raising capital, one shudders concerning the upcoming auctions in other European nations.
Yes, and the thing about that is that Germany has been very critical of this idea of the ECB issuing bonds and then having the ECB monetize those bonds, buying back their own bonds. But as a result of this failed auction of bonds, the Bundesbank has been actually buying back its own paper in the open market. So Germany, what's good for Germany is not good for the Eurozone, apparently. Again, showing this incredible split between Germany and the rest of Europe and the rest of the world, because they're pursuing self-interest really at the expense of everyone else now. Germany is out of control.
So German yields are higher than the UK's, which is just unprecedented. And of course, if you know that just even a cursory glance of their economies, the UK has no economy, literally. It's just financial fraud, and that's it. Germany has an economy that actually builds wealth and creates wealth, and yet their yields are higher than the UK's. This could be part of the financial war. We know Merkel and Cameron are in a little bit of a tit-for-tat.
Well, you know that in the currency wars, the objective for every country is to drive their currency cheaper, down lower, beggar thy neighbor. So the fact that the UK is trading above Germany shows that they're losing the currency wars. The idea is to get it cheaper. So they're losing. On the surface, it looks like that's a good thing, but actually in the currency wars, in this particular phase, it's a bad thing.
Well, speaking of currency wars, a lot of them we refer to as monopoly money, correct?
That's correct.
Well, as investors flee Groupon, outlook for IPOs darkens. So according to data from Renaissance Capital, the technology sector has seen 41 IPOs this year with an average first-day pop of 20.3%. Year to date, however, the group has lost about 13.1% in value. Explain this, Max, as part of the scam you say that these IPOs are.
Well, the Groupon IPO, we've been saying on this show for weeks now, leading up to the IPO, that it was a Ponzi scheme. It's a well-documented Ponzi scheme. Everyone in the financial press and on Wall Street knows it's a Ponzi scheme. But going into the IPO window, they have this first-day pop that's manufactured by Wall Street as bribe money, as currency money to pay off litigants, to pay off politicians. We know that insider trading in Congress is legal, so they give that to the congressmen, and they're trying to curry favor to deregulation. And then afterwards, within a week or so, as insiders get out of this piece of garbage that went public, the stock, of course, collapses. Now, in the case of Groupon, it's down well below its IPO price, and this whole IPO market has been completely undermined by the interest of the kleptocrats on Wall Street. Now, this is interesting because the big one, the mother of load of this whole window of IPOs, Facebook, has yet to go public. And this, of course, is Goldman Sachs' year maker. If they can't get that piece of garbage out of the IPO window, there's going to be a lot of unhappy Goldman Sachs partners. They've already broken the law at Goldman Sachs by giving stock to insiders beyond what they're allowed to by SEC law, and they must take it public or they will be definitely in breach of the law. But of course, what they'll have to do is give some IPO stock to congressmen to rewrite the law, because that's the way it works on Wall Street. If you break the law, just rewrite the law, and you use IPO money to bribe them.
Well, finally, Max, there's a big strike, national strike tomorrow in the UK, and I want to finally end on this headline because it goes with our first one where we see gold is up 19.3% for this year. UK incomes fall 3.5% in real terms. ONS reveals, this is the Office of National Statistics, and they say that there's a big fall in salaries for average workers and sizable rises for senior managers, according to the annual household earnings survey. UK households are facing pay cuts in real terms of more than 3.5% as salary increases fail to keep price with inflation. So wages are only up 1.4%, inflation is 5%. Max, we here at the Keiser Report have said that workers should tie their wages to money supply. As you see, with gold up 19.3%, it's keeping pace with real inflation. Directors and chief executives of leading organizations enjoyed the most sizable pay rises, with median earnings up 15%.
That's exactly right. People need to understand that the top 1% ties their wage to money supply growth, and the bottom 99% tries to keep their wages tied to something called inflation or the CPI numbers, which are useless. They're cooked up by government to hide the fact that they're getting screwed. If you want to be pari passu with the top 1%, you need to fight for wages tied to money supply growth. Money supply growth up 15, 20%, so should your wages. That's what the top CEOs do. They say, look, money supply is up 20%. I need a 20% rise in my wages plus a 20% bonus plus a 20% back-end bonus on top of that. So if you want to understand why you are so miserable and why your life sucks so badly and why you're such a loser, it's because you're tying your wage to inflation and CPI numbers instead of money supply numbers. Okay, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more coming your way, so stay right there.